Anyway, thank you so much for joining us. And for those of you that don't know, we've got Danielle DiMartino Booth with us, the author of Fed Up, and somebody that has impacted my investing and our clients' portfolio values as well. Danielle, thank you so much for joining us.
I'm delighted to be here.
All right. Well, we're gonna do kind of a rapid fire deal. I want to fit in as much as we can. Can you kind of give us a summary? I think that your career path and your experience is so interesting because we hear central bankers talk, we hear Wall Street investment people talk, and I don't really know of anybody else who has straddled both worlds. So kind of give us an outline of your career so the listeners can know a little bit more about who they're listening to right now.
So when I was fresh off the turnip truck in business school, I really didn't know what I wanted to be when I grew up. I didn't have a major. I just knew I was in Austin, Texas to get my MBA. And a few weeks after the beginning of my first year, a firm by the name of Solomon Brothers came to visit campus. Within 2 weeks, I was on an airplane to New York and staring out at my first trading desk. And I was hooked from that minute on. And I decided that I was going to be an MBA in finance, and I was going to go work and live on Wall Street. It was not an easy path necessarily for a girl from Texas, but I did land on Wall Street after I graduated. Great job, great firm, Donaldson, Lufkin and Jenrette, DLJ. It's no longer with us, but I got great experience. It was a junk bond and private equity firm. So if you can imagine the world we live in today, critical asset classes to become familiar with. And then 9/11 happened, and things changed after that for me philosophically. You know, how long is life? I had been going to Columbia Journalism School where I'd gotten my second master's in journalism at night. That was always going to be my long-term retirement plan, was to write about the markets. When you work in a sell-side firm, there's something called compliance, and you don't get to write much at all, at least not much that's true.
Yeah.
In any event, when I decided to follow my heart to Texas, I signed a non-compete clause with Credit Suisse. By then, we'd been bought out, and agreed to leave the industry for a while. Phoned up the CEO of Belo Corporation at the time and told him that I'd be willing to work for free at the Dallas Morning News. He said that was a fantastic price that was right in his budget. So I ended up with a column on the markets within a very short period of time, and it went kind of viral. People like you were reading it. I had readers in Tel Aviv and Australia, all over the place, and that is how Warren Buffett found me. And eventually, that's how Richard Fisher found me, and I came to answer the calling of my country, where I ended up being an advisor to Richard Fisher at the Dallas Fed for nearly a decade. I've since come out, and now I write a weekly newsletter. I wrote a book called Fed Up, and I'm much more visible, shall we say, than I was even when I was at the Dallas Morning News, and then when I was completely invisible in Richard Fisher's shadow at the Federal Reserve.
Yeah, I was going to say I'm hardly the highest profile person that read your articles and your work, even though it was very influential. But didn't you actually go visit Warren Buffett?
Oh, I did. I received an email one day from a Warren E. Buffett, and I'm like, spam if I've ever seen it. And I almost deleted it without opening it. But then I said, Warren E. Buffett, man, I wonder if that's really his name, because something about middle initials, it was really intriguing to me. And I opened it up, and as it turned out, Warren Buffett had become a reader of mine. And so he invited me out to Omaha. Great fun, mainly because I got to visit as much as I did with Charlie Munger.
Wow.
He and I had a discussion that was probably one of the most prescient of my life. He said that maybe not in my lifetime, because I'm old, but he's clearly up there in years. But he said, maybe not in my lifetime, but in your lifetime, you're going to see the pension fund industry go the way of the dodo bird. Because, and this was 2005.
Wow.
He basically said if central banks continue to interfere in the ability of the markets to conduct price discovery unfettered, so this is when Fed policy was artificially propping up real estate prices. He said if this continues, then there will be no such thing as the efficient frontier. And he's right. Yeah,
we've seen that play out. And so then to skip ahead a little bit, so you take the job at the Dallas Morning News for free, which they got a heck of a bargain. And what
They did pay me, and fairly quickly.
Yeah, I was going to say, I mean, they probably saw the readership jump quite a bit. I know, like I said, I know I was reading. So when did you first start? I mean, I know there's anecdotal news. You know, for me, it was watching people lose their brains and getting in arguments about people saying that, you know, real estate, God's not making any more of it. It can't go down. And that's when I first got cued in. What first caught your eyes? Where did you first kind of notice, wait a second, something's off?
Well, actually, it was right before I left Credit Suisse, and I was in a sales presentation, but a bunch of glossy investment bankers at the front of a room, pitching to the entire sales force something called a collateralized mortgage obligation. And I raised my hand and I said, "Who on earth would be stupid enough to buy the equity tranche?" And so fast forward, not very long, not very many years, and this was 2001 when I saw this presentation. I'm like, wow, they're making securities out of mortgages. They're slicing them, they're dicing them, they're making them accessible. The credit rating agencies are giving them a AAA stamp of approval. And that was really when housing got on my radar screen, and it didn't take very long to begin speaking with my reporter hat on, my columnist hat on. It was amazing how honest the traders were on these trading desks about trading 125% loan to value toxic waste. And those were their words, not mine.
Wow.
So traders are some of the most honest people in the world if you can get them to be honest. And that was what really clued me in, was that this was something that Wall Street was playing the investor. And whenever Wall Street plays the investor, it's not going to end well. And we clearly saw that it did not end well. Though The Big Short was very entertaining in the end.
Yeah. Now, so contrary to popular belief, certainly, you know, you're running against, and I know you're aware of this, but you're running against current economic theory and maybe economic theory forever. Bubbles can be spotted.
Oh, absolutely. Look, the idea that bubbles can't be spotted is a myth propagated by the Federal Reserve.
Yeah. We deal with that all the time. I get clients, well, bubbles can't be spotted. I heard that somewhere, and I went, well, wait a second. You know, I think I actually referenced your book, and I said they can be. You know, give this a read. You know, this happens all the time. So anyway,
and we are and it is harder today, not to jump ahead to the present day, but it has never been this hard to spot bubbles, because it's not a bubble anymore. It's bubble wrap.
Yeah. It's systemic. I keep sitting there looking at, you know, taking the client calls, looking at the market and the valuations and the moves, and it's just, it's remarkable to say the least. So, okay, so to get to present day, because we don't have you here, you know, I could probably spend 5 hours talking your ear off, but so what did we do? Now, I think this is one of the biggest misconceptions out there. We've got Dodd-Frank. What has changed since 08, 09? What great fixes have been put in? You worked inside the Federal Reserve. You know these people. You know the thoughts. What great fixes have they put in to make sure that, like Janet Yellen said, another financial collapse will not happen in our lifetimes?
Well, clearly they're still drinking their own Kool-Aid. It's the best drug in the world. The reason I wrote the book, because you don't have 4 young children and wake up one day when you're writing a weekly newsletter and say, you know what, I don't really have enough on my plate, so I think I'm going to write a book and just add to it. Now, these things do not happen in a sane world. But it was fed up with something that was, I had to do it. It was a personal catharsis on my part, because I was so angered in 2009 and 2010 to be on the inside, to witness with my own eyes the recognition inside the Federal Reserve that they knew that they were operating off of a broken inflation metric. And what they decided to do about that was approximately nothing. And that was when I got so upset. I said, this is hubris writ large, that these people know that they're working with a broken model. But because it's of their own making, they're going to stick with it anyways. There was a recognition, you know, had we had a better inflation metric, we might have been able to capture that runaway inflation in residential real estate. But there wasn't, so we didn't catch it. But rather than go to the mattresses and start over, they refused. They stuck with their old model, which means that they cannot see what's coming their way today.
And how did you feel when that transition was happening? I don't want to get stuck to this part because there's a lot of other things I want to pick your brain about that were in the book and about your writing in general. But what was it when the whole thing unraveled? Was there a moment where you sat there and went, and again, I'm speaking from my perspective, and so I'd love to hear yours, but I remember watching the whole thing unfold in '09 and everybody thinking, okay, we've got it fixed. Now markets are moving back up. And I remember sitting there going, wait a second, we didn't fix anything, right? Were you kind of in that same spot at the same time, or did you think maybe this will work? What were your thoughts when we were just throwing money at the problem, and then kind of tell us a little bit about what the Fed was saying at the time and their rationale inside, beyond just the broken inflation metric? Did they? I guess the point of what I'm asking is, did they really think they were fixing things, or did they recognize that they were more just masking the symptoms rather than treating the cause?
Recognition is apparently a very loaded word.
Yeah.
And I guess it's a difficult thing for people who are at fault to cotton to. So there was no recognition. It was really disturbing. It was sad. It was upsetting. And they understood that they had to roll out the liquidity facilities that they did, and they patted themselves on the back for saving the world with the first round of QE1, even though I was in deep disagreement that we needed to go to the zero bound to necessarily launch QE. I'm like, no, you're treating the patient with the wrong medicine. The price of money is not at issue. It's that people don't have faith in counterparties. So they're not extending the credit for that reason. Not because there's going to be a difference between the Fed funds rate being at 1.5% or zero. But instead, they had to lower it to zero. It was hubris. And from that point on, the few hawks who tried to hold their ground, this is Charlie Plosser in his day, this is Jeremy Stein in his day, this is Richard Fisher in his day, were overruled by the majority of professors. So then they proceeded to roll out QE2, QE3, and all that was placating the markets and, again, trying to extend the business cycle beyond where it naturally should have been.
And obviously that's what's going on today. And I one of the things that I loved in Fed Up was that inside look you gave into the Fed. And one of the things that fascinated me was when this whole thing was unraveling. And maybe I'm reading it wrong, and that's why I love being able to talk to you. But from the end, was there really this sense of calm and not panic? Was there a part of you that was pulling out your hair going, wait a second, people, do you see what's happening?
There were a few odd souls inside the Fed. It was not just, I'm not going to say I was the only person that was really worried about the housing market. But in general, if you rise up within the ranks at the Federal Reserve, the higher your seniority, the deeper the reverence. So if Chairman Bernanke's out in front of Congress saying that we haven't had nationwide house price decline since the Great Depression, and ergo, they would not repeat, most of the people on the inside took that as gospel, took it on faith, and walked away. And so the inability to question, the inability to raise a voice of dissent was so endemic, remains endemic. I'm hoping Jay Powell can fix it. I'm hoping that the culture itself can be reinvigorated by the first non-professor since Paul Volcker ran the Fed, which is a different story. But the group stink, as I called it, was pervasive throughout the organization, and it effectively stifled the ability to intellectually innovate.
The group stink. I love that. I've actually I've stolen that from you. So for those of you that are just joining us, we're got the privilege to be joined by Danielle DiMartino Booth, author of Fed Up, and a real prescient voice, one of the leading voices in the financial industry. We got to take a quick break, but we're going to be right back with Danielle DiMartino Booth. Stick with us. You're listening to Know Your Risk Radio on AM 770 KTTH. All right, and then we'll just jump right back into it. I'll introduce you again, and then we'll just take off running again, and I'll fire some more at you while we've still got you.
Awesome.
All right, welcome back to the show. Thank you so much for joining us, and we're going to get right into it. We are going to continue our interview here with Danielle DiMartino Booth, author of Fed Up, and one of the only people that I'm aware of that's been both on Wall Street and inside the Federal Reserve. So, Danielle, thank you so much for joining us, and let's pick up where we left off. So we were talking about your time at the Fed. Like I said, you're one of the few people that straddled both worlds. And I think what I experience, a lot of clients are tired of talking about 08, 09. I kind of see a bifurcated world. It's the markets and finance prior to that point, and then kind of what we're left with here. So due to the truncated time that we've got here and trying to fit it in the show, where does this leave us today? What do you see today? Is everything great? Are these markets going to the moon? Or do we still have some big lingering problems here?
Well, yes and yes. I think the markets are completely unhinged from reality. And when you see that the horse has left the stable, it's impossible to say where this is going to stop, right? We were lower for longer than we've ever been. We kept interest rates not just at the zero bound for longer than they had ever been at such low levels, but on top of that, we've got this $20 trillion global experiment in quantitative easing. So if you think of it as being of symmetry, the idea of symmetry, this bubble should be bigger because it was propelled by more air. Mm. Back in October, I wrote one of my newsletters. I wrote 3 for 3 for 3. And I said that we would end up having a 3% 12-month run rate on GDP. If you look at the latest gross domestic product data, it looks like there was a huge depletion of inventory that we know is going to be rebuilt. We could possibly see a 4% handle on Q1 GDP this year.
Wow.
But I said that we'd have 3% year-over-year GDP, which we have not had in years. I said we would have a 3 handle on the unemployment rate, and that we would have a 3,000 level on the S&P 500. And let me tell you, my Twitter followers were howling. They were in agony because I'm the skeptic. I'm the one who's calling out all of this bubble blowing. And it wasn't that I didn't think that the bubble was being blown. I just felt that it had completely come unhinged from reality, and that there was too much of the tax cut being built into gains, and that meant that we were going to trade on pure momentum going forward. And guess where we are? We're almost at 2,900 on the S&P 500, and back when I wrote that, we were at 2,500. So things are happening very quickly, and it's difficult to get out in front of these when they happen.
Boy.
Now, has anything been fixed? No, to answer your second question.
It's remarkable to me. And I want to fit this in too, because I haven't said this, but for those of you that want to read Danielle's stuff, which you're required reading for me, but go to DiMartinoBooth.com. Money Strong is the title of the website. And once again, do yourself a favor and buy Fed Up. I bought it literally the first day it was available on my Kindle, and I think I ripped through it in 2 days. Fascinating read.
That's easy to read.
Oh, yes, it was. And it was the great thing for me is when you're doing this for a living, or you're managing money for a living, and you're watching these men, I refer to them as the shaman of the day, right? It's they're reading the chicken bones, and that's not my idea. I stole it from somebody else, but I remember hearing that and going, I think it was Raoul Paul actually that said that. We interviewed Raoul about a year ago on the show, and he said that, and I was like, it's a perfect illustration, but we're wondering what's going through these people's minds, and you really shined a light on that. And it was just absolutely fascinating. So now, as you know, this show airs on Seattle radio, and so we're talking about all these problems. We're talking about these issues, and where do we go from here? What I always try to do is deduce things down to the base elements and try to figure it out. And I sit there and in my mind, and again, part of the information that I've gathered to make this assessment is from you and a lot of other people as well. But in my mind, I see this game going We're in the confidence game stage of the, as long as there's confidence in these fiat currencies that are propelling the system forward, that's basically how long it can last, right? I mean, we're running on vapor, we're running on fumes. Where do we go from here?
I have no idea. I don't know.
We've
never had, Deutsche Bank did a seminal report earlier this year. Earlier, and they did it in the fall of 2017, that said, looking back at data since 1800, we've never seen credit markets this overvalued. And we haven't seen populism where it is, since the buildup that began in the 1920s and finally rolled over after World War II. I don't know where we're going. When the United States was engaged in, when the Federal Reserve was engaged in quantitative easing at the peak, when it was $85 billion a month, at some point we got to where we were purchasing 70% of net Treasury issuance, over 80% of net mortgage-backed issuance. So we were the market towards the very end, and mechanistically we were needing to taper because it was difficult for us to continue down the path because we were going to run out of paper to buy. Well, Mario Draghi at the European Central Bank, he took that one step further. And rather than back off because he couldn't buy negative yielding sovereigns, rather than back off, he increased the scope of what the ECB could purchase to include corporate bonds. And in the end, in December, before he backed off, because now the ECB is in a tapering mode. Nobody really wants to hear about that. But that helps answer your question, by the way.
Yeah.
But in the end, right before the ECB started to taper their purchases, they were buying 7 times the run rate of sovereign issuance. 7 times. So the bond market bubble in Europe is bigger than anything that we could ever fall back on referring to the United States. If we were just buying 70% of issuance, 7 times, 700% of issuance.
Yeah.
So it is. We are so far out on a limb, I can't tell you where we're going. And I can't tell you what the catalyst is going to be. We saw a few weeks ago that Mr. Draghi was left literally holding the bag because one of the corporate bonds that he had purchased was downgraded to junk, and they had to write it off completely.
Yeah, what was the name of that one?
It's impossible to say. Commercial real estate is more overvalued than it's ever been.
Yeah.
I can't get that ringing in the background to stop. My apologies.
No problem.
But commercial real estate is more overvalued than it's ever been, and the people in commercial real estate know it, and they still tell you with a straight face.
Yeah.
We've got nothing but upside from here. Nothing but upside from here. We live in a different world.
It's
and we know the bond market's more overvalued than it's ever been, and we know that the stock market is not as overvalued as it's ever been. And if you watch CNBC or any of the major financial networks, that is the one thing that the punditry is falling back on, is the fact that they can point to March 2000 and say, we had a 43 PE at the time, and right now we've only got 30. So it ain't as bad as it was, so therefore, buy. Well, okay. But we didn't have share buybacks the way we have these past few years, because if you look at price to sales, we are exactly where we were in March of 2000.
Well, and then the Warren Buffett indicator, right? Total market capitalization to GDP is, what are we at on that? I want to say 141 or something now.
Oh, yeah.
Yeah.
Margin debt as a percentage of GDP is at an all-time high. You don't want to say that margin debt's at an all-time high, because then they'll come back to you and say, well, what about as a percentage of GDP? Now you can say, yes, as a percentage of GDP, it's at record levels. And that doesn't even begin to bring into account other forms of margin that are out there, like portfolio margin, that don't even equate, that don't even get poured into that equation.
Yeah. See, people, all the listeners out there, it's not just me. Now, I've stolen a lot of your ideas and gotten a lot of them from Danielle DiMartino Booth, who's joining us right now. But it's not just me. And one of the things that we've been talking about for a year and a half now is risk management. And one of the points of this show and our practice in general is bringing the idea of risk management beyond 60% stocks, 40% bonds to people's portfolios. So, obviously, based on what you're talking about, you and what you're saying and what you've got in the book, you also agree that risk management's an integral part of where you need to be looking at things today and the way you need to be managing your assets. What do you think the approach? And I'm not looking for specific general, specific recommendations, but for the retail, that's the most of our audience, obviously, retail. What are steps that they can take? Do you think that risk management and figuring out ways to fireproof certain parts of the portfolios, is it gold? What advice would you have out there for the average retail investor and our listeners to navigate these times?
There's no good answer. And that's why I don't envy you. I don't envy anybody in the money management industry because, I can remember back in 2008 and 2009 when correlations between asset classes lined up perfectly and there was no other place to hide but gold.
Right.
So it's a very difficult question to answer. One of the unintended consequences of zero interest rate policy is that typically the most defensive stocks in your portfolio, the high dividend paying ones, were bid up the most.
Yeah.
So, it's very, very, me personally, I'm not going to skirt your question. I will tell you, I own a lot of strong municipal bonds because just because Illinois is going to melt off the map and California does not necessarily mean that there aren't good general obligation municipal bonds out there. And my 71-year-old mother owns a Ginnie Mae fund, which, it keeps pace or surpasses the pace of inflation. But that's just me. A lot of people, if you're young, if you got the risk tolerance, if you feel like you can have your equity holdings cut in half and you're going to live long enough to build that back up, then fine. Stay in the market and drink the Kool-Aid that long-term investing is the only thing that pays off in the end. It's not what I do for myself or for my loved ones.
Yeah. And those blue chip dividend payers, the historically cheap ones paying dividends, they're still good options too, right? We got John Deere at a 31 PE, Cat at 110 or something like that. That's the other thing that blows my mind is the valuations on, Costco at a 30 PE, good companies, right? But the valuations have just gone parabolic. And yeah, well,
that's the thing. Warren Buffett before Warren Buffett became a politician. So I think he's a different investor now that he's become a politician. But before Warren Buffett became somebody who had political opinions, he always, one of his mantras is something that holds true today, and that's just because it's a good company does not mean it's a reasonably valued stock.
Right. There's no such thing as bad assets, just bad prices, right?
Right.
Well, anyway, I know you got to get going, and I can't say thank you enough for joining us. For those of you that have just joined, again, we're with Danielle DiMartino Booth, and the author of Fed Up. Her work has been instrumental in our practice and has helped save our clients money, especially during 0809. I can't strongly recommend the book enough. Also, go to DiMartinoBooth.com. You've got what would you like to say? What can the average investor or retail investor? It's not just institutions that use your services and buy your books. What can we get from Money Strong and what can the average investor learn from you and what's the best way to learn that stuff?
Well, so there's a lot that you can read in my Bloomberg column, and that's clearly out there for the consuming. And if you feel that having a very contrarian take on the world, mind you, but a comprehensive view of the world and where I think the economy is going, and you kind of want to have the flip side of everything else you hear, then jump on a trial subscription. Try out my newsletter for 30 days for free and see what you think. And that really is the best way to go about it. You just go to DiMartinoBooth.com or follow me on Twitter at DiMartinoBooth. That's never boring. And just have a look for yourself.
No, it's not boring. I'm a follower. I'm a follower, bought the book, and we're actually signing up for the newsletter, so hold me to it. You're going to see a subscription come through from Bulwark Capital, us, and we're gonna subscribe as well. I kept forgetting to do that. But anyway, thank you so much for taking...
You get a 30-day look back into the archives as well. So you get to go and read... what I published this last week was a seminal piece called Soccer Monsters, the Lamborghini and the carpool lane. And it was talking about, how macroeconomically important the inequality divide is when you consider what's happening demographically in our country.
Oh, yeah, I couldn't agree more. By the way, you also pointed out to me, I think you said in one of your columns or one of your pieces that you walked outside the mall and you saw an unbelievable collection of new, what was it? These luxury SUVs.
Rolls Royces.
That's right. Well, I also saw Lamborghinis coming out with a new SUV, and it made me think of you because I thought, boy, isn't this a sign of the times?
Well, that is literally the image for this last week's newsletter. I've got the Lamborghini up there. That's my Soccer Monsters image. And I'll tell you this much, you'll giggle when you see it. But go have a look on my website and then shoot me a Twitter and tell me what you think about what I put on that license plate.
Oh, I can't wait. I'm going to do it today. So thank you so much for taking the time out of your busy schedule. I hope you guys enjoyed it. Again, go buy Fed Up. Look, get the newsletter. If you want some inside information and more, a clearer picture of really what's going on out in the world, I can't recommend Danielle DiMartino Booth enough, and it's one of our sources, one of our trusted sources. So anyway, thank you so much for joining us, and we're going to keep following you on Twitter, and hopefully we can get you back on when some of this stuff shakes loose and get a refresher.
I'd be delighted to. Thank you so much for your time.
All right, no problem. Thank you. And all right, thank you all for listening. This is Know Your Risk Radio on AM 770 KTTH. We got to take a quick break, and we'll be right back.